All right. Can everyone hear us out there?
Testing.
All right. Test this. Test.
You can pop in the chat if you're on YouTube. If you can hear us, we just want to make sure, and then we can get going.
Awesome. Well, welcome everyone. Thank you for joining us. This is the live stream with EdgeQX and Scott Andrews from InvestiQuant, where we will discuss how robust is your trading plan. I'm going to pull up our quick PowerPoint presentation here. First things first, disclaimer. Derivatives trading carries a high degree of risk and may not be suitable for all investors. Please note that there can be a material conflict of interest for your account based on your FCM choice, platform use, and data feed execution. Opinions expressed are solely their own opinions and do not reflect opinions of EdgeQX, and past performance is not indicative of future results. And I'm going to turn that off. All right, well, my name is Max. I'm here with Ian. I am the Vice President of Brokerage Services here. I've helped, along with Ian, launch EdgeQX, and it's been about 2.5 years now, right, Ian?
Yep, 2.5. Launched in April of 2020. Fantastic launch time.
Yes, it was definitely an interesting time.
Awesome. And I'm Ian. I'm the Director of Brokerage Services here. I just wanted to float that out there. And as Max mentioned, he and I basically started EdgeQX from the ground up, and here we are today.
Awesome. Ian, you want to introduce EdgeQX, who we are, what we're doing?
Absolutely. So EdgeQX is an independent introducing broker. We're futures brokerage, and we cater to the active trader. So our goal, Max and I, when we went out to start EdgeQX, was to, we knew the IB business, and we wanted to offer something to traders to not only just earn their trading business, but become your partner, keep you around for the long term, right? Trading's hard enough as it is, and part of what we're going to be discussing today, I'm sure we'll get into that a little bit as well. But that's really the goal with EdgeQX, and we're constantly innovating and developing tools for our traders.
Speaking of developing tools and innovating, is part of our conversation today is going to be about EdgeQX. EdgeQX is an automated program that is run through an LOD at EdgeQX. It's designed for the active trader to diversify their portfolio and performance. This gives everyone a chance to participate in a defined plan and execution process, which brings us to what we all want to talk about today, which is trading plans, right? So we brought on and we asked Scott Andrews from InvestiQuant to come on and discuss trading plans and how he creates it and what he looks for when he's developing automated or his own trading plans. So I'm going to bring in Scott right now. Scott, can you hear us?
I sure can. How are you?
We're doing great. Thanks for joining us today.
Excited to be here.
You want to make a quick introduction on who you are for the audience?
Yeah, so I've been trading a couple decades. I was fortunate to take a technology company public as a young man in the 30s, and had a little time and money and decided I wanted to manage my own capital when I left that job, and figured it couldn't be too hard to do that, to time the market. Hired my original developer, and he's been my partner for the past 20 years. We developed portfolios of intraday trading strategies, so day trading strategies. We've evolved to trading them systematically, exclusively over the years. Launched a company in 2008 where licensed my signals to retail and professional traders, and we've been doing that for about 15 years now. Also, we'll talk about later, a developer of some of the strategies that you guys offer there as well.
Awesome, thank you for that. And yeah, we're excited. We don't do these often, so we're excited to work with you on this and listen to some of your opinions and on creating trading plans, which I'm just going to dive right into it. How does a pro quant trader create and trade a plan long term?
Well, I think the fact that I'm a quant really just talks about how I get my edge, right? I'm a very research intensive kind of person. So all of my edges are statistically based through analysis. But other than that, creating a trading plan is really the same. A good trading plan, whether you're a discretionary trader or a quantitative trader, to me is the same. And it begins, there's really three components I think you need to think about. One is, what are your goals? Right? You have to begin with the end in mind, as Stephen Covey would say. They need to be, if you've ever heard the acronym SMART, specific, measurable, achievable, relevant, and time-based, right? So that may sound obvious, right? Everyone just wants to make as much money as they can, but I would like to add one huge criteria in that it should be relative to one's own risk profile, right? So I've seen many traders get in trouble with this first step just because they have unrealistic goals. They try to just focus on making as much money as I can with the money I have. But if you really peel the onion back and think about that, you need to keep the money you have in order to make the most money. You can't run out during the process of pursuing profits. So that's a big mistake people make. But that is the first one. So identify what you think is a realistic profit opportunity for you, goal, financial goal. For creating your program, your plan, and your strategies. Second step is to create those actual strategies, right? Identify edges that you can leverage and tailor for your own risk profile to pursue your goals. A lot of people think it's really, oh, I just need one really good strategy. I'm a small trader. And sometimes that is true. There's no doubt. There are examples of individuals who have perfected some very nuanced technique around a support or resistance level or what have you, right? However, I would suggest, from just interacting with hundreds, if not thousands of traders over the years, including many professional traders, there's very few one-trick ponies. It tends to be work best. Your odds of success are best if you have multiple strategies or techniques that you can take advantage of. So it's just like as a regular passive investor, diversification is king. I'm a huge believer in having multiple ways to generate returns in the marketplace because nothing works all the time. It just doesn't. Mm-hmm. So yeah, go ahead.
I was just going to say, you mentioned one system, some develop one program and it works. How many if you could throw a stab at it, how many trading plans do you think you've ran into and you've built since you started?
Yeah, I think of it a little bit differently. I have one big trading plan, right? So big long-term objectives that are all SMART as I define them. And then in order to execute and achieve those goals, I've got many different strategies. So a strategy is a little bit different than a program. A program is a portfolio of strategies. So when I started back in, say, 2000, my first portfolio of strategies, so my first real go-to-market, manage my capital and grow it was around 2005, 2006. And it was 5 different related but different strategies. 2 were designed for bull markets. 2 were designed for bear markets, and 1 was designed for neutral or sideways markets. And this was just my thought process was I needed something that would be working regardless of what the market environment was doing. I rightly or wrongly, I think I ended up being pretty right that my instincts were at the time, because I didn't have the experience to know this, was that what worked best in bull markets was very different than what worked best in bear markets for trading short term. And I was all about short term, ultimately evolving to day trading, as I mentioned. It was never my life aspiration. I certainly didn't think that I'd be doing that after taking a company public. But it's a great way to leverage your capital, right, and to have lots and lots of sample sizes to evaluate. So I want to evaluate as many examples of setups and scenarios that I can study as possible. So,
got it. I do want to mention one thing. For the audience, if you have questions, feel free to throw it in the live chat. We'll answer them at the end unless something comes up that we're able to ask Scott on. But feel free to share any questions. But just want to throw that out there.
If I may add, also just to answer your question, I have roughly 100 strategies that are spread across many different programs for different markets and so on that I actively trade today. But honestly, I make most of the money off of probably a handful of them and some derivatives of them. So.
Cool. That brings me to another question, Scott. Like, how do you, when you're developing this, how do you make sure your program or your strategy is robust? Right? You mentioned you have probably hundreds. What are you kind of looking at during that process?
Yeah, so sort of two steps of it. One is the design theory. Even though I'm a quant, I'm not one of those guys that mines data all day. I don't believe in that. You just get fooled by randomness and noise when you do research. So I always start with something that I call it my 3 C's for creating an edge or identifying an edge. Some causative logic. So I try to understand a scenario in the marketplace, just observational, like a simple pattern that makes sense to me. So real simple example that works in different markets at different times. But let's say we had a big sell-off, a red candlestick in the market prior day. And then we gap up and open above the prior day's high the next day. My view is if that's occurring after we've had a bit of a run up, then you've probably got some people that were shorting the market the day prior, and they're going to be stuck. They're going to have stops just above those highs, which is going to add fuel to the long side. So I have strategies that would go long in the right contextual situation, just going the opposite direction of a prior colored candle. It's really that simple. So that's the logic. Then I want to go in and I want to test that for different contexts. And sure enough, that scenario I just described works better after a run up than say after a sell off. It's all about context. So I want contextual confirmations, the second C. And then the third C for me is I do want some type of confirmation that I just didn't get lucky with this idea. I try to test. So if I have a strategy on, say, the S&P E-mini futures, then I want to see that concept holds up or at least doesn't fall apart when applied to, say, the NASDAQ. So those are my 3 C's. That's how that's sort of the first part of identifying an edge. And then it's all about take those rules that create my rule set to trade. And I want to go back and I want to look at it in sort of 3 phases, or 2 phases at a minimum. I back test it. So I want to see that shows an edge that meets my profit criteria, right? I'm looking at really just how much money can I make with sort of a per unit of risk, or how much risk I'm willing to take, apply for a given strategy in a given year or period of time. And then I want to then take that strategy and run it out of samples. So I don't want to get too nerdy here, but the whole idea is I back test using historical data up to a certain point, stop it, refine the rules, trying not to curve fit or over optimize for targets or stops. I really don't, I leave those alone, generally speaking. I'm using volatility based targets and so on. And then I apply it to a new set of data that's called walk forward or out of sample testing. So I may say create a strategy, test it up through 2018 in my back test, and then apply it from 2018 to present for my walk forward. It should, if I have done everything properly, it should conform somewhat similar to how it did in years prior. That's the goal. And then the third step is, start trading with live money if everything holds up. And then I'm very patient. Once I start trading with live money, I don't take those decisions lightly. If I start trading it, I'm not going to stop trading it a month later because it lost money. Nothing makes money every single month. And it's a real long-term view.
Yeah. I mean, that's a key piece here, I guess, and we'll go into it later. But it's never a program that wins 100% of the time is not going to exist.
They don't.
Great. I guess to feed off one thing you mentioned in your answer is back testing. Do you have any advice from someone that may be just getting into this type of development and would like to backtest? Do you think something, a platform that offers backtesting capabilities will suffice?
Yeah, I mean, backtesting is an imperfect science, but I wouldn't be talking to you right now if I had not mastered the art of backtesting. Looking backwards is the best example or indication of how an edge may play out in the future. And remember, a lot of people talk badly about it because they don't probably know how to do it properly. But when I'm backtesting, remember one of my C's, right, we talked about was context. Nothing works all the time. So with that said, and with the premise that some strategies work great in raging bull markets but fall apart in bear markets, that makes sense, right? There might be a long bias strategy, and vice versa. Some work great in bear markets and not bull markets. It's all about context. So I create rules and test. Personally, I used TradeStation for decades. I still have it. I got so frustrated eventually as our company grew, InvestiQuant, I challenged my team to build our own backtesting platform. We have an interactive research platform. I'm not here to promote it, but it is available publicly. It allows you to test intraday strategies with it's pretty simplistic, though very powerful. Thousands of different combinations of indicators, market conditions, and so on, just to identify directional biases for the day or for the first hour or what have you. So when you have data like that, it gives you enormous confidence. Now, I want to say one other thing, and this sounds really old school, but I know there's a few old farts listening to me right now that are just like me, that maybe aren't as comfortable, though, with programming and back testing, and they can't teach an old dog new tricks. I started my original research before I even learned TradeStation was I printed out 2 years worth of 5-minute charts. The S&P, actually it was the Dow mini futures. I migrated to the S, but I printed those out and I got very comfortable with my simple. That's really how I stumbled on my mean reversion concept, just fading the opening gap. I realized that 70% of the time, wherever market opens, the futures intraday will revert back to the prior close. And once I could see that, and I could see the price action, and sometimes it'd run away from the open, then collapse, or vice versa, it gave me enormous confidence to really pursue it and risk real capital and use maybe bigger stops than other people use, because I know that there's a sort of a bias that's that has some logic to it.
Yeah. I mean, just so everyone knows, there's platforms out there that we can help with too that does back testing. We all know past performance is not indicative of future results. Just want to throw that out there as a brokerage firm. But I do think it's a really good tool to help redefine and refine your trading strategy.
Cool. Can I just add to that? Just to belabor it,
Go for
just one really important point. I don't understand how you can call yourself a trader if the edges you're trading, you don't know everything about them you possibly can. And that includes how they have performed historically in different volatility environments and different trading environments. If you're just winging it based on what's worked for the past 5 years of a raging bull market prior to this year, then you're probably struggling this year and you're feeling the pain. You don't have to do that. Yes, you can take your ideas. Your ideas are not, so super secret. You can't share them with some other professional developer to code them for you. We don't offer that service, but there are plenty of them that do. Absolutely, pay someone if you have to learn what you don't know about your own strategies.
Yeah, and I think a key piece to this is, and I've seen it many times, and what I always tell traders, and this is something we'll probably go over later, but we're talking about it, so I'm going to bring it up, is you'll see hypothetical results, back-tested results, and you'll see live results. My opinion is try to see if those live results match the back-tested hypothetical results. If it's way off, way skewed, maybe something's a little bit off there. But I always like looking at it, just in my opinion, looking at the back-tested results and the live results. And if they're somewhat similar, then it seems like that it's been able to perform in, or it's been tested in all different types of environments.
Yeah. Well, and Scott, for you, I mean, as someone who discovered quickly that I don't know what I don't know when it came to trading my own money, you mentioned your 3 C's. How long does it typically take you to go kind of like soup to nuts? You're in the phase where you have the idea, and then you start back test, then the walk forward, and then feel comfortable deploying it live.
It's not a super quick process. I try to spend a little bit of time on research every day, certainly every single week. So I have set aside time that I can be in a trade, but I won't be making any trade decisions. I'm systematic, so I'm fortunate. It certainly takes weeks if I'm going quickly to sort of take concept, because I'm just doing a little bit each day. I like to iterate ideas. So I may spend 30 minutes one day, an hour another day. I may do a deep dive and spend 4 hours on a Saturday, trying to validate and refine rules. I try to keep them very simple. So causative edge, something that makes sense to me, shrinking volatility, and then you get a breakout move, whatever. But I used to spend, and it's actually faster now. I can do it in days if I want it. A lot of the time used to be just the coding, working with the coding language of, say, a TradeStation or what have you. So again, everything I do now is mostly point and click. But
Yeah.
there's so many different things you want to test and understand also, right? The different, whether it be seasonality type filters, calendar event, market events, how does it react on Fed day, options expiration day, monthly jobs report day, are there exclusions that should be added to your strategy or not? How does it work in low vol versus high vol? There's a lot of factors to test. The good thing is it makes you smarter. Every time you create an edge or find an edge, you learn a little bit about how the market works. You've built your own sort of internal knowledge that you can leverage, and it gets a little bit easier. Frankly, it really is a lot easier now, and maybe exaggerating, but anyone starting out should expect to spend at least weeks. And my first program, as I mentioned, or portfolio of strategies I talked about, probably took me a year to put together. I upgraded it a few years later, and that took me about 3 months. Again, doing other things, but these are intense process. But the payoff is massive, right? I mean, you've got the ability to have strategies that will be essentially all weather, that can work in all types of market environments. And then once you've sort of done that, then it's a matter of very minor tweaking, refining, trying not to touch anything, only slightly improving from time to time.
Yeah, and I think that goes along too with what you said earlier about, if you have the idea, but you're not entirely sure what your edge may be, paying a developer, sharing that information might help you start to learn that. And then once you've done it, you at least have something, right? You have a base that you can work off of and
That's right.
upgrade and continue to build.
What would be a small tweak for the audience here that may not understand? Okay, I'm trying to think in the audience's point of view that may not have an understanding of building a trading plan, but when you come across something that needs a small tweak, do you have an idea, or are you able to elaborate on what that small tweak might be?
Yeah. So one of the things that's sort of always in play in the markets broadly, and we've dealt with them more over the past 10 years, is as index values expand and have expanded, right? They've 2008, the bottom in 2009, I think the low was 666 in the S&P futures. And then, as you know, we rallied all the way up just shy of 5,000, right? In a matter of, 14 years? Crazy exponential growth, really. One of the things that changed in my strategies was a 1% move. I used to need a 2% or 3% move to really, or use a larger stop on a percentage basis. Percentage-based stops and targets really didn't work as well because the moves were so small. So as it kept expanding, the stops were getting bigger to the point they exceeded my own personal risk tolerance on given strategies. So a tweak would be changing from a percentage-based exit to maybe a fixed base exit, or meaning a fixed number of points that I'm willing to risk in a certain volatility regime. So I've got volatility regimes now. When it's super volatile, the strategies turn off or switch to micros or deleverage. Something has to happen. You just don't want to keep trading the exact same risk, because then you're just taking on more than you intended. So markets are always changing, evolving. There's always something like that. I'm thinking about trying to be as consistent, allow the edge to trade out as originally designed as much as possible.
Got it.
Yeah. And as Max mentioned to everyone watching, we're not necessarily going to have like a designated FAQ slide that we show you. But if you do have questions right now, I think there's only 2 right here in the chat. You can pop them in there and we will address them here question by question. So fire away. So now, Scott, we have one question for you.
Yeah. And keep in mind, we also have a special that we're providing at the end of this webinar or this live stream. So stay tuned. That'll be there. If anyone's got any questions, please throw them in there.
I'll show one now if I can. And I think this is maybe more related. I don't know that this is really in the context of what we're discussing. I'll pop it up here. The question from David was, do your strategies include money management? Just wondering, David, if you're referring to like dividends, tax harvesting and things like that, or if this is more general money management.
And Ian, while he types the answer there, I can run with that, because there's actually a third part that we haven't talked about. So as I think about creating a plan, right? We talked about the SMART goals. We talked about creating your edge, right? A lot of people tend to think that is the plan, right? Creating the edge and the strategies, and that's That's really all you've got to do. Well, there's a whole third element, and that's your actual trading plan, right? How are you going to execute that plan? Are you doing it on a discretionary basis or systematically? And what are your rules for dealing with the inevitable unique scenarios that happen continuously in the marketplace? I remember when there was a big Brexit vote coming one time and the markets were going insane, and that wasn't built into our plan. We had to decide we're going to allow our strategies to trade or not. What about if you have a locked limit day? What are you going to do? What if it's a Fed day and Fed announcements are typically around 2 p.m. Eastern time? What are you going to do? But to the point on money management, I think he's talking about drawdown management, right? So your account balance, everybody starts with an account balance. You're trading hopefully multiple strategies. You might be trading an auto trading program like EdgeQX in there as well. And what happens, how do you manage when your account goes down, right? Because we don't make money every single month. Nobody does that. Is there an uncle point that you have identified psychologically where you're going to stop trading, stop and reassess? You should probably have that, in my opinion. That's what I've always had. There was always some fixed line in the sand that I had to say, whoops, I'm not going to tell the wife, but I'm done. This program, this strategy, there's an uncle point. So I have uncle points on every strategy where, I'll only allow it to lose but so much money before I have to stop and reassess. And then what do, right? So one of the, and I'm just sort of rambling here a little bit, but one of the because I think it's probably the most important topic we could talk about is if you're creating your own strategies, is do you deleverage, right? So you built a big hole with a big shovel. Do you switch it out for a smaller shovel to start filling it back in? Personally, that's been one of my own techniques that I've done if I've gone into a hole, just to slow the burn, buy a little bit of time until the strategy starts performing again. And the key is to switch the small shovel for a bigger shovel where you're putting on more risk. So shovel is just an analog for how much risk you're taking. So
yeah, and David did clarify. He said, referring to the sizes of he said bet, but I'll say position, drawdowns, and targets.
Yeah.
So that's what he was. Yep.
Yeah. So how much are you willing to risk on a single day? That's crucially important. Yeah. Some people don't have those caps, so they blow up on literally one day, and that's ridiculous because the markets. The way I think about it, trading statistically based edges, right? Edges that I found that have stood sort of the test of time, they have some logic that I understand. They still may have a 60% win rate. They're going to be wrong 40% of the time. And I used to sort of get upset thinking, I can get it to 70%. There's just one, I need to tweak the rules a little bit. And the reality of it is that I've learned the hard way, and this is a great nugget. The markets simply don't conform to history every day. Vast majority of the time, 60, 70% of the time, they are conforming to history, but not perfectly. So at least one time out of every three, the market's got some outside influence that's unique to that market environment. It might be a major player that's imploding and they're just dumping that day. There are all kinds of market flows that are unique to every single day. So even the best statistical edges, they're just not going to work a chunk of the day. And the good news is they don't have to work. You can make a lot of money with strategies that work 40% of the time. We have some strategies that I trade. They're part of the program we'll talk about in a few minutes. They have 40, 45% win rates. But when they're right, they make 2 or 3 times more than they lose. So a lot of ways to get where you're trying to go.
Yeah, and that goes along. There's a couple more questions pouring in now. People have opened up to the questions, so that goes along with this same vein, right? You typically, I'll fill in the blank here, set a daily loss limit or have a daily loss limit on these strategies, right? So yes. You had mentioned like it could be 40% of the time it's right, which means 60% it's wrong, which in turn means obviously you have to have some sort of fixed risk so that your winners are outpacing the losing trades. Right?
Absolutely. Every strategy and the entire program, before I go into the day, I know the maximum I'm going to lose, that I could lose. Now, most of the time I'm not maxed out at the max daily risk. I don't want to necessarily do that. But in certain situations, depending on volatility and sort of ideal conditions, I'll go up to my max daily limit. And those days hurt when they're wrong. That's, again, the value of being diversified. When you have more than one strategy, ideally 2 or 3, often you can, sort of hedge your performance for the day. So max daily risk is key. And then you also need to have that other sort of line in the sand. And I'll say this within my own programs. the line in the sand is hard. So we've, and strategies do change. So we've added performance criteria. This works for me. You have to be a bit of a quant or coder to do this, but you can make your strategy smart and loop back in their ongoing performance into the decision. Will it allow itself to trade that day?
Yeah.
So that's one of the cool things we do, but it's a little more sophisticated.
Yeah. I'll follow up with one more here, and these kind of go as well. So related to the position sizing, basically they're asking, are you spreading the strategies across multiple accounts? Would you consider running something if you have different markets in one single account? I guess going along with the diversification as well.
Yeah, I can't say it's necessarily evolved in a logical way for me. Just over the years, I started with one broker for a number of reasons. I opened accounts at other brokers, and now I've got money sort of spread everywhere, which is a bit of a mess, but I use it personally. I've got different groups of strategies with different markets trading in different accounts. It keeps it sort of clean to understand. And that's not uniform necessarily. I do have programs that trade multiple markets in the same account also. I don't know that there's a right or wrong answer there that necessarily matters. I think you do want to separate. So again, diversification is king. So you want to have enough separation where you can say, okay, I'm using this strategy A over here. I want to see how, if it stops making money, I want to be able to stop. I want to know that and not have it hidden by the fact that strategy B and C, maybe we're carrying the load. So you want transparency, whatever works for you to make it easy to keep track of all that. To me, it's just easier to look at the statements and have accounts separated in that regard.
Awesome. And then say another one from Prop Master here. Going along that, do you prefer the strategies that I think what we're referring to here is may have a lower win percentage? Do you have a preference, or do you, again, that goes with the diversification? Like if one's winning 45% of the time, but it's positive, right? Do you prefer that, or would you like to see something that has a higher win rate?
Great question. One of my favorite questions to tackle also, because my position has changed over the years. First off, there's no right or wrong, right? He's asking for my preference. But let's start with remembering there's two types of capital: your financial capital and your emotional capital. Emotional capital, frankly, probably kills more traders losing that, your confidence, than the financial capital, because most people are disciplined and it can minimize the risk in that regard. So for me, I recognized early on I did better psychologically if I felt like a winner more times than not. I don't know if it's my ego or what, but I prefer strategies for the first 10 years of my trading that had higher win rates. So by definition, to have a 60% win rate, you're going to typically make a little less than you're risking because you're using a bigger stop relative to the trade you're pursuing. So I might pursue, just for simple math, $100 or $1,000 would be my profit opportunity for the day, but I might be risking $1,200 or $1,400 if I was pursuing $1,000. Sometimes even $2,000. I'd risk twice as much. But I got to have a super high confidence in it. And it's got to be a really specific situation. And I'm always looking to reduce that risk after the open as fast as I can. Now, with all that said, when I started out in back early 2000s and through until about 2014, I would say, when QE really took off, I was a mean reversion strategy primarily. I'd say 80% of my profits, maybe 90% came from fading, right? Trading the opposite direction of the prevailing morning trend, or maybe fading into resistance or support, going the opposite way. As the market evolved and became more of a momentum type environment, I started making most of my money by following the gap. So trading in the direction of the opening move or looking for opportunities to do that. And those you can typically make twice of what you're risking, for example. So I ended up adding those strategies in. And today, I don't really care because everything I've got has positive expectancy. Some have risk more to make less, but have higher win rates. Some risk less and make more and have lower win rates. And combined, it sort of gives me the best of both worlds.
Yeah. This next question kind of goes along with what you were saying. You're trying to get things off after the open as quickly as possible if you've got more of that risk, right? So he's asking, is your position sizing all in or all out, or scale in, scale out, or a combination? So what are you looking for there, basically?
Yeah. Typically, I am, well, today I've evolved to the point where I like to create individual strategies down to the contract basis, and then there'll be multiple variations of the same edge. So I might have 3 different strategies. One will have a tight target and a tight stop. They're just different combinations. So they will sort of naturally scale in and scale out on their own. I always found it hard as a discretionary trader before systematic to scale into a position. I felt like I'm in a winning position, and I know this is what a lot of pro traders do. I just psychologically couldn't get there. Adding to a position that's already winning, I struggled with that. I felt my best edges were going in aggressively and then managing my risk. It's not how other people have done it, I know, but for me, it was just easier to do that. But in general, scaling out and locking in some profits when you can makes sense. But we have a program, for example, that trades one contract. It's a really sophisticated program, and it's a directional sort of end of day hold. And it just sucks when you're riding a position and it'll go up, and y'all have seen some of these trades run and then reverse on you, and you can give away sometimes the whole profit that's made. Sometimes you can even turn it into a small loss. Most of the way we trail stops and adapt, they don't ever become full losses. We try to keep them from becoming any type of a loss. Hard to do though.
Yeah, cool.
Awesome. Well, I mean, if there's other questions out there, feel free to email us. We talk to Scott quite a bit, so we can always get back to him. But I do want to bring up, I do want to talk a little bit about our EdgeQX program. So we got a special coming on after. I'll go over in a second, but hypothetical disclaimer. We're going to be talking about some hypothetical results in a bit, as well as live results. But we do want to just show this, let everyone kind of review it. It's on our website as well, which I'll go to right now, actually. If you want to follow along, go to edgeqx.com. Type in edgeqx.com, and it'll pop up the EdgeQX program that we partnered with InvestiQuant on. So when you get to it, here's our webpage. You know, it kind of goes over what the program is. It is powered by InvestiQuant. So we've been working with them very closely on it. It's man, Scott, we started. It's been a while, right? Since we really
we're talking years, not months.
Yeah, it's been a little while since we first started, and you know, I just want you all know that we have 2 programs. It's on the ES and the MES. And like I said in the beginning of the program, that we believe that this gives everyone a chance to participate in this defined trading plan and execution process, because it does have a low barrier of entry than traditional, you know, automated programs that you may see. Like I said, hypothetical disclaimer, if you do want more information, fill this out. You're not signing up, you're just getting more information, and we'll contact you about it. But to see the latest cut sheets, what we want to do right now is we want to talk to you about the cut sheet, you know, what questions we have seen, what we look at, what we believe are good key statistics to keep in mind when you're looking for any program. It could be EdgeQX, it can be, you know, InvestiQuant, whatever program it is. We believe you should look at certain pieces of this data. So, you know, we do have the MES program, which is a $10,000 initial investment, and an ES program as well. And again, this is done through an LOD at EdgeClear. So contact us and we'll go into more detail. But these are the key statistics that we've put together and we've published to traders. And you know, I guess the first thing I want to say, and I always like to say this to any trader that's interested, is it's not so much focus on the P&L and the profits and any of that. It's more so the key piece is this max peak to valley drawdown. I always say look at that. Why? Because this is the worst drawdown hypothetically in the program. But the key piece of this is it's the worst drawdown until the next worst drawdown. So it will happen. You'll run into drawdowns. It's inevitable. It's going to happen. So we always say, hey, this is the worst drawdown right now until the next one, hypothetically. That's a key piece that I personally like to look at, or on any type of program. And I'm sharing this to you now is because we want you to be aware of risks involved all around, as well as the potential that it brings into play. But that's my key stat that I like to look at. Is there anything, Scott, that when you're looking at this that you like seeing on a technical or quant-based
Yeah,
program?
well, yeah. Let me get a little bit of the soapbox. I think you nailed it. There's a lot of different factors, and I've wasted years of my life studying different metrics and what's the best metric, and we do some cool things using statistical metrics. But ultimately, what you said is the single most important metric for every single person to be aware of and to focus on. And I'm going to put it right out there because I want people to be successful with this program and or with their own trading, whatever they do, because this is the one thing that trips up almost everyone that doesn't make it. Ultimately, people quit because they lost more money than they could handle financially or psychologically, like we mentioned, right? So they look at a back test. In this case, it's a combination of the hypothetical with some live trading there as well. And then they will often say, oh gosh, that's not bad relative to how much money I would have made during that time. And then they get all obsessed and excited about the returns. And yeah, you got to be excited about the returns. That's why we do this, right? But then they forget to circle back to really anchoring in their mind how much risk and what it's going to be like to endure a drawdown. Because I'm going to tell you, drawdowns are part of the business. It's like buying your inventory is, if you're in the sales business, you have to have inventory that you have to expend money on before you can sell it. Well, it's the same thing here. This is an investment that goes into making money in the markets. It's impossible. The other thing I want to key on, if I can, Max, is that the reason you're going to have a bigger drawdown in the future is not because Max is covering his, you know what, it's because he's right. Because all programs, well, I shouldn't say all programs, our programs and volatility-based programs like this make the most money when the markets are volatile. They can also lose the most money. So it's two edges of the two sides of the same coin. As index values continue to go up over time, a 1% move in the S&P is going to continue to get bigger and bigger. That means we're going to have bigger and bigger gains and run-ups. And we're going to start hitting that capped stop amount, the maximum risk that it'll take in a given day on a larger and larger or more frequent basis. It's just the way it goes. So if you want to make money, you got to risk money. But if you can't handle the number shown there and really put yourself in a situation, assume a worst case scenario, you started the program and you're the unluckiest guy of all of EdgeClear's clients. And we have another drawdown similar to that max peak to trough that on the, I'm looking at the micro tear sheet right now of $3,144. If your account lost that much, remember, it could be bigger in the future. At some point it will be. How are you going to be psychologically? Are you going to quit the program? I would understood if you did, but you just need to know that is a risk. And if you do it, probably at some point it does recover. That's the nature of certainly programs like ours that are adaptive. They go through these peaks and troughs. And some people, they get on board and catch a big run up and it's all good. You're hoping you're one of those people. But if you catch a drawdown, you really got to be committed to it, in my mind. Or at least make that just a known line in the sand and chalk it up as to rotten luck. But you can't blame a program if it loses more or something comparable to that drawdown, because it's the nature of how these things make money.
Yeah, I mean, it's not a matter of what if, it's a matter of when it'll happen again in any program.
Yeah, and that's something too that we like to go through with everybody who's interested, and certainly if you do contact us, you're going to get the same conversation with myself and our brokers here. Yeah, as Scott said, you have to be comfortable with that and the idea of potentially more than that, and how, I think what he said most importantly is how would you handle that situation, right? If it's something where you say, if it hit that, I'm quitting, then you might want to reevaluate how you're perceiving the program or what you're looking at. But if it's something where you know, as Scott mentioned, it's going to happen and you feel like you can stick that out, then it could be a good fit for you, right? And that's just a per trader conversation that we like to have.
Yeah, I'm glad to hear you. And I know you guys do that, but it's let me give you just a little conceptual framework for people to think about. Also, think of it as if I'm an ex-Army helicopter pilot, so I think in terms of risk. Right, those things aren't supposed to fly; they don't glide. I can tell you that. So think of yourself. You're on a mission, right? You're trying to get, just like a pilot would think about it, right? You're in flight, and you're trying to get safely to some other point. You have to think about your emergency procedures. You're not sitting there thinking about what a beautiful day it is. You're always thinking about what could go wrong. What if I had engine failure? Well, with an auto trading program, engine failure is a drawdown. How do you survive that drawdown, right? You can actually land a helicopter without an engine. It's called auto rotation. Well, you have to have emergency procedures in place on what you're going to do when you hit that drawdown and what you're not going to do. And if you pre-plan it, then you handle it not in the stress of in the fog of war, but in a pre-planned, careful, methodical way, so that you can get your feet back on the ground, recover, and go on and stay in the game long term. Because that's how you make the most money over the long term, is to stay in the game long term, not to switch around from strategy to strategy, trying to get lucky, catching a run up. And, it just doesn't work that way. Take a long term view, keep your eyes on the horizon. That's the name of this game.
Yeah, long term view is another key piece to this, and what we always suggest as well. It's our opinion. It's let it run for a year. We suggest if you want to do this, it's our suggestion, our opinion, that you should let it run for a year and then properly assess the program. Long-term view is
100%. I cannot tell you when we're going to make money and when these strategies are going to lose money. If I knew, I would not be talking to any of you.
You'd be in the Bahamas right now, trading on your own, drinking some Mai Tais and not talking to anybody.
Yeah, most years most years these strategies make money, but depending upon when your year starts, remember, people start at different years. There are going to be people that may not make money if they have really rotten luck. They have just catch a 12-month period where it was break even or lost a little bit or made a little bit, where there could have been people that started 3-6 months beforehand. I mean, look at the returns on, October was a great month in the program, right on the heels of a really crappy month in September. If you look at the charts there. So depending upon when you start, it makes a completely different view, and it's impossible to predict. So you don't have to, but you should take that long-term view, commit to it for a year, and see where you are a year from now.
Yeah, absolutely. Yeah, and like I said, we got an ES and an MES program, and I think we're about to that point, unless you guys have anything else you want to say about this portion of it. Oh, one person said there's a small difference between performance between ES and MES. Most of the difference there's going to be small differences due to many different reasons: fees, slippage, type of stuff like that. It's similar, but because of the totally different type of contract that you're trading, ES versus MES, and the depth, order flow, all that fun stuff is the reason why these are not, as you can see, not really one-to-one. But what we do, in the live results is we take into effect the slippage and all of those fees and all that stuff. So it's a key piece to know. But do you guys have anything else you want to say about this, or?
Well, I'll just add that and this might, I'm not trying to sound self-serving, but just being honest, if you can trade, if you can afford the bigger contract, the E-mini, it's a more liquid market. On a relative basis, the fees and slippage and so on are going to be a smaller percentage, just the way it works.
Yeah.
Yep.
Cool. Well, that leads to one last piece, which I think I have another slide here. Yes, which is our early Black Friday deal. But anyone who joins EdgeClair and joins EdgeQX by November 30th will receive a $100 credit towards their annual license. So
is that for both the ES program and the MES program, Max?
That's just for the MES program.
Got it.
Just for the MES. ES is just a little bit different. But the MES program, we're providing a $100 credit towards your annual license if you join by November 30th. And that's all I got for everyone here today. Does anyone have any questions? Last chance. All right, I think we're good. Again, visit edgeqx.com. Reach out to EdgeClair. Scott, thank you so much for coming on. Really, really appreciate it.
Yeah, we appreciate it, Scott. And if we didn't get to your questions, please contact us. We can even ask Scott if it's more in line for something with him, but Scott's also a very busy guy. So Max and I are capable of answering a lot of these.
Oh, absolutely. And I spend a fair amount of time talking to Ian and Max as well, so they know how to reach me best. So happy to help anytime, guys.
Thanks, Scott.
Yep. Good
All right,
trading,
everyone.
Carl.
Thanks again for joining, and hope to hear from you all soon.